Imagine you wake up tomorrow and discover that money isn't real. Not metaphorically, literally. The numbers in your bank app, the balance on your card, the digits you send to friends, none of it is physical. None of it exists anywhere you can touch. And yet, you trust it. That quiet leap of faith is the foundation of PayPal. Not the app, not the logo, the idea. And that idea almost failed so many times, it's a statistical miracle you've even heard the name. Here's why this story matters right now. Because every time you tap your phone to pay, every time a creator gets paid online, every time a stranger sends money across the world in seconds, you're using a system that was invented by a handful of paranoid 20-something founders who thought banks were slow, governments were clumsy, and fraudsters were smarter than everyone. They were right about all three. To understand PayPal, you have to forget modern fintech for a moment and go back to the late 1990s. The internet was loud, messy, slow, full of dial-up noises and blinking text. Buying something online felt dangerous. Sending money online felt insane. If you wanted to pay someone on the internet, your options were basically mail a check, call them, or trust them blindly. So when two separate startups appeared with the same strange idea, most people laughed. The first startup was called Confinity, founded in 1998 by Max Levchin and Thiel. Their original idea wasn't even payments, it was security software for handheld devices, Palm Pilots. Yes, those plastic bricks executives once carried like they were futuristic relics. Then they added a feature: send money from one device to another, just as an experiment, not as a business. Meanwhile, across Silicon Valley, Elon Musk started a different company called X.com. It wasn't a social network, it was an online bank, which sounded bold and reckless and slightly absurd. Banks had marble floors and guards. Musk had servers and code. Both companies accidentally discovered the same thing. People didn't care about digital banking, they cared about sending money, fast. That's when things got weird. Instead of competing forever, the two companies merged in 2000. Not because they were friends, because they were running out of money fighting each other. The combined company eventually became PayPal. But at the time, it looked less like a financial revolution and more like a chaotic science experiment run by brilliant insomniacs. Their office culture was legendary. Employees slept under desks, arguments broke out daily, executives got replaced. At one point, Elon Musk was CEO. Then he wasn't. Silicon Valley politics before it was fashionable. But inside that chaos, one insight quietly formed. Sending money is more powerful than storing money. That sounds obvious now. It wasn't then. Banks thought the opposite for centuries. Banks focused on holding money safely. PayPal focused on moving money instantly. And movement is addictive. Here's how they proved it. They started paying people to join. Literally, sign up and get $10. Invite a friend and get 10 more. It was like a digital pyramid scheme, except legal. The company was burning millions each month just giving cash away. Investors watched in horror, but something strange happened. Users didn't just sign up, they stayed. Because once you've sent money instantly once, waiting 3 days feels prehistoric. Growth exploded, especially on one website, eBay. At the time, eBay was the Wild West of online commerce. Strangers selling things to strangers. Collectibles, electronics, weird antiques, sometimes questionable items that probably shouldn't have been sold at all. And every seller had the same problem. How do you get paid safely by someone you've never met? Checks bounced, money orders were slow, cash was risky. PayPal solved them all at once. Buyers trusted it. Sellers trusted it, so eBay users adopted PayPal without being told to. No marketing campaign, no official partnership, just pure utility. By early 2001, more than half of eBay transactions used PayPal.
That's when the uncomfortable math appeared. Growth is exciting, but payments attract criminals like honey attracts ants. Fraudsters realized something before PayPal did. If money moves instantly, stolen money moves instantly too. Scammers began creating fake accounts, stolen cards, fake auctions, phantom products. Every successful transaction meant 10 fraudulent attempts behind it. At one point, PayPal was losing millions to fraud every month. Most startups die here, not because they lack users, because they drown in abuse. But PayPal had a secret weapon: paranoia. The founders assumed attackers were smarter than them, so they built systems that treated every transaction like a potential crime scene. They hired mathematicians instead of bankers, engineers instead of compliance officers. They wrote algorithms that watched behavior patterns: how fast you type, how often you log in, where your mouse moves. If something felt slightly off, the system froze the account. Users complained. Fraud dropped. This was new. Traditional banks used paperwork and rules. PayPal used data and probability. Banks asked, "Is this allowed?" PayPal asked, "Is this suspicious?" That subtle shift changed digital finance forever. Because suspicion scales, paperwork doesn't. By early 2002, PayPal had something rare: explosive growth, strong fraud defenses, and one very interested giant watching closely: eBay. Remember, PayPal wasn't officially part of eBay, which meant eBay had a problem. Its entire marketplace depended on a payment system it didn't own. That's like building a city, but letting someone else control the roads. So eBay made a decision: buy PayPal. Price tag? $1.5 billion. At the time, critics called it overpriced. Today, it looks like highway robbery. Because PayPal didn't just process payments, it became the default trust layer of the internet. And trust in finance is everything. But here's the irony. The thing that made PayPal powerful wasn't technology, it was psychology. When you pay someone through PayPal, you're not trusting the seller. You're trusting PayPal to intervene if something goes wrong. That tiny shift removes fear, and when fear disappears, spending rises. PayPal understood something banks ignored for decades: convenience is stronger than caution. That principle built the modern digital economy. But success created a new problem: scale. As millions joined, PayPal transformed from scrappy rebel into financial infrastructure.
And infrastructure has rules. Governments stepped in. Regulators asked questions. Anti-money laundering laws applied. Compliance departments grew. The same company that once moved fast and broke things now had to move carefully and document everything. Some early employees hated it, because rebellion is exciting, compliance is boring. Yet without compliance, payments stop. So PayPal adapted again, quietly, methodically. By the mid-2000s, it wasn't just an online checkout tool, it was a global money network. People sent rent through it, freelancers got paid through it, families used it to move money across borders. Something subtle had happened. PayPal stopped being a product, it became plumbing. And nobody thinks about plumbing until it breaks. Here's the hidden mechanism most users never see. Every time you send money through PayPal, several things happen simultaneously. First, PayPal checks your balance. If you don't have enough, it pulls from your bank or card. Second, it verifies the recipient. Third, it runs fraud analysis. Fourth, it records the transaction. All of that happens in seconds, not because it's simple, because it's automated. Behind the scenes, thousands of micro-decisions fire instantly: probability scores, risk thresholds, behavior comparisons. If risk looks high, the system delays or blocks. If risk looks low, it flows. So when you tap send, you're triggering a miniature financial investigation. You just don't notice. That invisibility is deliberate.
Because visible complexity scares users, invisible complexity builds empires. Now zoom out. PayPal didn't just create a payment tool, it trained the world to expect instant money movement, which created pressure on everyone else. Banks had to speed up, card networks had to modernize, governments had to rethink digital currency rules. Competitors appeared: Stripe, Square, Venmo, Cash App, Apple Pay, Google Pay, all chasing the same thing: your trust. But here's the quiet truth. Most people don't choose payment apps based on features, they choose based on habit. Once your friends use one platform, you use that platform. Once your clients pay through one system, you accept that system. This creates a network effect, which is finance's version of gravity. The bigger it gets, the harder it is to escape. PayPal understood this early. That's why they focused obsessively on user growth before profits. Because in payment networks, size is safety. Small networks look risky, large networks feel inevitable, and inevitability attracts more users. It's a loop, a self-reinforcing loop. But loops have a weakness. They rely on confidence. Remember the earliest lesson of banking history. Systems survive on trust. If trust cracks, speed becomes danger. Instant payments mean instant panic too. If users suddenly believed their money wasn't safe, withdrawals would surge instantly. Digital bank runs happen faster than physical ones. No lines, no doors, just taps. PayPal knows this, which is why their real product isn't payments, it's reassurance. Every email confirmation, every buyer protection message, every dispute resolution, all of it is theater designed to signal control. Not fake control, visible control. Because users don't just want safety, they want proof of safety. That distinction matters. Now, here's where the story gets quietly fascinating. After PayPal succeeded, many of its early employees left and built other companies. You've heard their names: Tesla, LinkedIn, YouTube, Palantir, Yelp. This group became known as the PayPal Mafia. Not because they were criminals, because they spread everywhere and influenced everything. It's one of the most concentrated bursts of entrepreneurial talent in modern history, which raises an interesting possibility. Maybe PayPal's greatest product wasn't software. Maybe it was founders. But success stories hide friction. PayPal still faces the same fundamental tension it had on day one. Move money fast, stop fraud faster. Those goals fight each other constantly. Speed invites abuse, security slows speed. So every payment platform lives on a tightrope. Lean too far towards speed, criminals win. Lean too far towards security, users leave. There is no perfect balance, only constant adjustment. That's the part most people never see. Finance isn't stable, it's tuned, continuously, quietly, relentlessly. And now we arrive at the present moment. Digital payments are everywhere. Children send money before they understand banks. Businesses operate entirely online. Entire economies run on invisible transfers, which means the original PayPal idea has become normal. So normal we don't question it. But maybe we should, because the entire system rests on a shared belief that digital numbers represent real value, that servers will keep running, that companies will stay solvent, that algorithms will stay accurate, that trust will hold. History suggests trust always holds until it doesn't. And when it breaks, it rarely warns you first. So here's the unresolved question. If the future of money depends on systems like PayPal, who's really holding your money? The company? The bank behind it? The government regulating it? Or just your belief that the number on your screen still means something tomorrow? That answer is less obvious than most people think. And the moment it becomes obvious, that's when finance changes again.